explore with me this idea of pyramiding to be done effectively, and if you have any recent trades to share with us around this idea.
Yeah, so pyramiding is basically the idea of, you put on an initial position in a trade, and then the trade begins to go your way. And when the trade is going your way, at a certain point, it develops a structure where you can realistically change your risk from where it was originally and move it to a tighter position. And so when that happens, you can then add to your position and get up to the same dollar risk level that you had originally, but now you have a larger position. And then if the position continues going in your favor, you could theoretically do the same thing. And so if you have kind of a big picture trade where there's multiple opportunities where you can move your stop up and get a tighter stop and then increase your size, and then the same thing happens, you increase your size, move your stop up, you can get to the point where, you might have had a 10K initial risk on a trade, but you just get so big after adding and moving your stop up that 10K initial risk turns into $1 million. And that actually happened to me recently on this Bitcoin breakout that was I think in the middle of July, if I'm not mistaken, where I originally took a $10,000 risk on an options position. And I was able to pyramid that into $1 million gain after 4 days.
Wow. Story is crazy. And when someone hears those numbers, they're like, wow, I'm going to do that right away. If we can kind of draw a line, maybe it's a blurry line, but just kind of what is the separation between euphoria, greed, chasing a trade, and getting overzealous on an idea and over conviction versus the art of doing this correctly in terms of, okay, this is scaling in, this is a de-risk the principal and then ladder in. How do you deploy that differently?
It's very difficult. There's a lot that goes into it, and I think a huge part of it is having put the work in before to know how the stock that you're trading moves and what the tightest pivot points are that you can be adding on, and not just adding randomly into strength, because if you add too much too soon into strength and then it pulls back, you're going to ruin your average and you're going to stop out for a loss. And so I think really you have to know exactly where those pivot points are. And that's something that only comes through experience and just really knowing how these patterns play out and having a bunch of examples of them.
I usually get to kind of entries and break-even drills later on, but we can explore it since we're here. Is the philosophy here that the first trade you got in with the 10K risk in this example, it's an independent trade with this independent trade idea, entry criteria, and XYZ. And then once that starts to ride into profit, do you have a break-even protocol and then reuse that principle on the next position?
Yeah.
Okay, so it's not necessarily increasing risk. It's recycling the same risk is what we're doing here when we pyramid.
There's different ways that you can do it.
Okay.
As your conviction in a trade grows, you of course could choose to use more risk than you initially had, even on the first position. But typically, the best way to do it is to not do that, because obviously, the farther the trade goes in your favor, theoretically, maybe the worse the EV is getting at that point, because it's already so far above your initial entry. So, I think it doesn't always make sense to risk a lot more on those later entries.
How would you do it? Would it be following it with an EMA, or is it kind of market structure related?
I think both. Yeah. I mean, for me personally, I prefer to use market structure and just for example, on the Bitcoin trade, I had a trade back in November of last year where I made I want to say 300,000-ish on the breakout. But I learned a lot because in that one, I did a terrible job of pyramiding overall. And I kind of fumbled that aspect of the trade, because every time that it was working and it would break to new highs, I would be adding aggressively on those new highs with a really tight stop. And then I would just sell those ads on the first pullback. And that actually ended up costing me I think an extra $100,000. And I never got to have that extra size. Versus if I did it the way that I did on this most recent trade, I probably could have made $1 million on that trade too. But I learned those lessons from that one, where the way that Bitcoin likes to go a lot of times is it will have a support level and it'll wash out under that support level, and then it will go once it flushes everybody out. And so that is specifically what I was looking for on this. The daily structure is still intact. It got really tight and then it broke out through, I believe it was the 112 level, but don't quote me on that. And then once it did that, then it kind of confirmed my overall thesis on the daily. So at that point, I was looking for these washes and reclaims to be adding size and risk versus the low of that wash that was under the support level. Versus before, I would buy as it's going through resistance, and a lot of times it would just clear out over resistance and then come back down into mid-range, and I would just puke it at lows because I was oversized with a bad average.
I trade a currency, so a healthy currency market is generally maybe on a long time frame, but it's a consolidating market, unless it's a very weak currency that we're trading. But in the stock market, indexes, crypto, generally speaking, they're an appreciating asset. So there's a baked-in trend. When you are entering at all-time highs or extremely high periods, around 100K and beyond on Bitcoin, for example, and I remember off camera, you're kind of saying some trades are intraday, some trades can even be swing. Is this idea of like, okay, if this intraday plays works out and I've got this tide on my side, I might as well ride it into a swing trade and beyond? Or is there different models for different times of the year?
I think whenever I'm going into a swing trade, I always have the idea that it's going to be a swing trade, just because the way I structure trades are very different if not for that. Like if I'm in a day trade and I buy something and it immediately, for example, in the options, I think I was up by the end of the day on the entry. I'm pretty sure I was up like 100% on the options. If that's a day trade, I would be taking that immediately. But because I had the swing trade thesis, I ended up holding those and selling for like a 500 or 600% gain after 3 or 4 days. So it's just a very different trade plan when I come in knowing that it's going to be a swing.
Is your main technical driver, because I'm familiar with this Bitcoin play recently, are you kind of waiting for a range, a consolidation, maybe call it an accumulation, and then trying to anticipate the breakout and directional bias, or was this just one trade example kind of thing?
I think that's just one of my favorite patterns in general, is just a big picture breakout where you get a really nice move and then the stock or asset, whatever it is, forms a really tight range and then perks through that range. That's just one of my favorite patterns of all time, because especially if you structure the trade the right way before volatility expands, you can just get some incredible risk to reward on that. And if you pick the intraday spot because you know that the daily is super primed, like I literally risked like on one of the ETFs, I risked like 10 cents on BitX. Okay. I risked like 10 cents on my entry and ended up getting like $10 a share.
I see.
So when all the time frames align, you can get some incredible risk to reward.